Hi, I'm Rich Frankel, author of OneWorldEconomics.com. That's 360 pages long, so I'm presenting my key findings in a series of short YouTube videos. This slide deck looks at the volume and effect of international trade in the United States. The first thing I noticed about international trade is how huge it is. Total world trade is over $30.5 trillion. That's larger than the US GDP, which is the total US output. Trade is 50% of the average country's GDP. Imports and exports are 25% of the US's GDP and 33% the size of China's. The reason trade is so high in most countries is because small countries can't produce everything themselves. Not every country can have an automotive industry, for example. Large countries are less reliant on external trade. Trade took off because of lower shipping costs, computerized logistics, and trade agreements that lowered tariffs. The US is the world's second largest exporter, with over $3 trillion in exports in 2023. Our imports were $3.8 trillion. In 2023, the value of trade was over 30 trillion, as we just said. This image is a snapshot of shipping on a recent day. The colored areas are continents and the white areas are oceans. Super tankers and container ships ply the oceans. We've all heard about the loss of good-paying factory jobs that don't require a college degree. Often trade is blamed for these losses. But as this chart shows, the decline in manufacturing employment as a percent of the total has gone down in all advanced economies, including Germany, the blue line, which is a manufacturing powerhouse running the world's largest trade surplus. You can see here that the decline has been similar in France, Australia, Canada, Britain, and the United States. I've marked the date when NAFTA was signed and the date when China joined the World Trade Organization and liberalized trade. Neither has a discernible line on this effect on this trend line. The real reason for the decline in manufacturing jobs in advanced economies is automation. It takes far fewer workers now to produce a larger amount of goods. The value of manufacturing output has increased in the United States, even while the manufacturing employment has fallen. Mechanization and automation has reduced employment in agriculture and manufacturing. 80% of us now work in what are called services, and AI may drastically reduce the need for labor in many services. While manufacturing employment has declined, our exports have ballooned in dollars. The US is the second largest exporter in the world behind only China. So this is the blue is our imports, and red is our exports. And as you can see, they've grown. This is in real dollars, meaning adjusted for inflation. As you can see, they've grown enormously and are about now 25% the size of GDP. While we have a large trade deficit compounded by growing government deficits, imports and exports together are about 25% of the size of the US economy. Anything that hurts US exports will cause job layoffs. Trade always lowers prices or makes new goods available. Think about it. There are only two reasons to buy from abroad. The item is cheaper or you can't make it locally. Think clothing and bananas. We buy clothing from lower wage countries because it's cheaper. We buy bananas from abroad because we can't raise them here. Lower prices equal higher pay. People understand that inflation cuts into pay, but overlook that lower prices are like higher pay. Clothing is an example. Imports of clothing from low-wage countries decimated U.S. clothing manufacturing in the late 1990s. But in 1960, the average American household spent over 10% per year on clothing. By 2013, the average household was spending 3.5%, despite buying far more clothes. That represents a savings of over $2,200 per year per household. The clothing workers found new jobs, but some of them may have lost income. The benefits from lower prices, that 2,200 overall households, could pay for losses many times over. Winners from lower prices, all of us, could more than compensate the losers, those hurt by trade. While not officially tracked, internal trade is thought to dwarf foreign trade. That's trade between the states. Both increase productivity but cause job dislocations. Trade increases productivity because every country tends to make and export what they are best at. This is called comparative advantage. This flow diagram shows the effect of increasing trade between a low wage, low productivity country and a high wage, high productivity country. Using clothing as an example, the low wage country produces clothing, which is imported by the rich country. That reduces employment in the rich country's clothing industry, but increases exports in high wage, high productivity occupations such as industrial robots and high value services. Productivity increases in both countries. In the poor country, there's often inefficient agriculture. The earnings from exports help modernize agriculture, which then makes more workers available for growing industry. In the rich country, clothing workers have to find new work, but new jobs open up in high value goods and services exports. This increases productivity. Meanwhile, prices for clothes come down, making almost everyone richer. If we remember that higher productivity equals higher national income per person, we can see that both countries got richer. Of course, the distribution of that income can be unequal. This is a simplified explanation of what is called comparative advantage in trade, which was first explained by the brilliant early economist David Ricardo in 1817. There's plenty of statistical data to back up the assertion that trade is beneficial. What is the economic effect of trade in the United States? First, let's look at what happens when trade barriers such as shipping costs fall. When trade with China expanded, it had a negative effect on some industries. In the US, clothing and electronics being examples. This is called the China shock by some economists. Economists estimate that at its peak, the China shock was responsible for about 20% of job dislocations in manufacturing, the rest, the other 80%, being due to automation and other factors. After an initial trade shock passes, industry settles into a new equilibrium and job dislocations subside. The US continues to import most clothes, but exports a lot of high value goods and services. Prices for many goods declined. Exports increased enormously, as we've noted. The US trade deficit increased. We'll discuss that a bit more later. This diagram revisits the one we looked at before that showed the effect of newly expanded trade between a poor and rich country. After industry adapts, we can see that the clothing industry is gone in the rich country, but that it produces high value goods and services for export. No further job losses occur. Of course, tampering with trade will at this point cause job dislocations again. In the last chart, we didn't discuss the flows of cash between the two countries. For most countries, the value of imports has to equal the value of exports. Any difference is made up by incurring debt or selling assets. We saw that the US exported $3 trillion in 2023. That's our exports. But we imported 3.8 trillion, so we ran a 800 billion trade deficit. This slide shows the dollar flow going out for imports in orange and the dollar flow coming back in for exports in green. When imports exceeds exports, money will stack up, like these stacks here, in foreign countries as shown by the money sacks. In smaller countries, exchange rates adjust to balance exports and imports, but for a large, rich country like the US, foreigners are happy to use this extra cash to buy US assets. They buy US stock, 40% of which is now owned by foreigners. They also buy treasury bonds to finance the enormous US government debt, 30% of which is now held by foreign governments and individuals. We have to pay interest on those bonds. Finally, they buy US property and companies. In short, we in the US live beyond our means. To reduce our trade deficit, we need to reduce our borrowing. As we discuss in the episode on US taxes and spending, the huge national debt has been brought about not by increased spending as a fraction of GDP, but by tax reductions. We could reduce the balance of trade deficit by increasing taxes back to what they were before Reagan and by other measures to increase national savings, such as consumption taxes. Tariffs. Before the graduated income tax was passed as a constitutional amendment in 1913, the major source of federal revenue was tariffs. Back then, tariffs were called custom duties, and everybody knew they were a tax that raised prices. The Boston Tea Party was a reaction to British tariffs making tea more expensive. There are legitimate but limited reasons to impose tariffs, for example, to protect developing industries. The U.S. is highly capitalized, and tariffs are just an impediment to trade that raises prices and reduces productivity. In a country with an advanced economy like the United States, limited and highly targeted tariffs can be justified as a way to protect strategic industry, but of course, this goes against free market principles. A 10% across the board tariff is calculated to cost the average American family $1,700 per year. When coupled with lower income taxes, which we are expecting, it effectively increases the tax on the middle class and poor and lowers it on the wealthy. Tariffs are just about the worst way to combat a trade deficit. Trade misconceptions. When I first started my deep dive into world and U.S. economics, I was a trade skeptic. My preconception on the effect of trade on the U.S. was formed during the decline of the auto industry in Michigan, the decimation of the clothing industry in New York City, and the outsourcing of some service jobs to lower cost countries. Of course, the decline of the auto industry in Michigan was as much due to the large auto manufacturers moving production to non-union southern states as it was to making car parts overseas. But it still looked to me like labor's bargaining position was undermined by lower wages in other countries. And I wasn't wrong in that impression. But what I missed were the enormous benefits of trade, which are often less apparent since they show up in prices that are lower, often much lower than they would be otherwise. With that introduction, let's take a look at some of the misconceptions about trade. Trade causes job losses, trade is a major factor in reducing demand for labor, and trade reduces wages. Misconception: trade causes job losses. We have record low unemployment in late 2024, but also record trade. Clearly, trade doesn't cause permanent changes in employment levels. When trade expanded, some people lost their jobs and others gained them. Usually, the jobs lost to trade are low productivity, while the new jobs and exports are high productivity. When the economy adjusts to trade, few additional job dislocations happen. As we've seen, trade is not the major factor in reducing manufacturing jobs. Automation is. In sum, trade does not cause overall job losses. Misconception: trade reduces the demand for labor. The counter-arguments are pretty much the same as they are for trade not causing job losses. We have record low unemployment in late 2024, so clearly trade hasn't reduced the overall demand for labor. Trade is not the major factor in reducing manufacturing jobs. Automation is. Agriculture went from employing 80% of the population to 1% now. Nobody blames trade for that, even though we import and export a lot of agricultural products. 80% of us now work in service jobs, which mostly aren't affected by trade. The level of employment in a country is managed. Almost all economies in the world are now what are called managed capitalist market economies, including China. That means that governments and central banks work very hard to keep unemployment from going too high. Employment level, income distribution, and wages can all be influenced by government. We will discuss how modern economies are managed in other videos. In sum, trade does not cause overall job losses. Misconception: trade reduces wages. Trade does put downward pressure on wages in trade competitive industries, but workers can take other jobs. Those industries that can't compete paying prevailing wages give way to ones that can. Let's use the clothing industry as an example again. In order to compete, U.S. clothing manufacturers would have had to reduce wages, but they couldn't do so because the workers would have left to take other jobs. So the clothing industry mostly disappeared, which brings us to the next point. Wages in a market economy are determined by supply and demand. With most labor demand coming from non-tradable services, the overall wage level is not determined by trade. When the clothing industry disappeared, that didn't bring down wages generally because wages are set by supply and demand across many industries and businesses. Trade lowers many prices. This gives us all a real increase in income. Again, as we've seen, the prices for clothes plummeted with lower cost imports. The same is true of consumer electronics like your TV and smartphone. As we discuss in the episode on U.S. income inequality, national income and productivity has continued to grow while trade picked up. The distribution of that income, however, has become more unequal. Overall, trade increases national income per person and has little effect on wages. Some studies say that trade has increased income inequality, and some say that the lower prices of traded goods has reduced inequality. Overall, there are much more important determinants of wage inequality. We deal with that in the episode on reducing U.S. income inequality, but here's a spoiler. In a market economy, pay is determined by supply and demand for any specific type of labor. And in an economy that requires less and less labor to produce goods and services, most jobs that don't require special skills or training can look forward to smaller shares of national income. That isn't because of trade. This chart from the episode on U.S. income and wealth inequality shows that net national income per person, the green line, has continued to rise while trade greatly expanded. But little of that has flowed through to ordinary working folk, which is this lower line here. Since this chart accounts for changes in prices, it includes the effect of lower prices in traded goods. Labor productivity has gone way up as automation has boosted output per hour. National income per person is how much take-home pay has risen on average. In short, how much all incomes would have gone up had income increases been distributed the way they were before 1964. Simply put, a rising tide has lifted some boats a great deal more than others, and there's no correlation with trade volume. Growth has continued unabated. To summarize, international trade is huge, larger than the US GDP, which is our total economic output. Trade reduces prices and increases productivity. These effects are not just theoretical, they've been repeatedly shown in data. Trade increases total national income, but can have a damping effect on the incomes of affected workers. Overall, the winners from trade, all of us, could more than compensate the losers. Tariffs negate the benefits of free trade and are a tax primarily on the middle class and poor. Balanced trade can be achieved without tariffs by policies that increase national savings. That would be good for many reasons. Like automation and the capitalization of agriculture, trade is good for the aggregate economy. Income distribution is a separate issue. Thanks for watching. In upcoming episodes, we'll suggest ways to reduce income inequality in the United States without hampering our capitalist market growth engine. We'll also look at the highly related topic of government spending and taxes in the United States. If you missed it, background for this episode is the one on U.S. income and wealth inequality. All these talks are based on research presented in the book One World Economics, which you can find online at oneworldeconomics.com. There you can find sources for all the data presented here, as well as my background. I plan to release about one video per week to cover these topics. Please subscribe to get informed of new ones. If you found this video useful, here is another you might like. Click the globe above to subscribe and learn about new videos. I plan to release about one a week. See oneworldeconomics.com for in-depth coverage of these topics. Thank you.